Hi, Mr. Arun. Welcome to Bharat Alternates. It's being very, glad to have you on board. So just taking 2 minutes and giving a little background about Mr. Arun Subramanyam. So Mr.
Sure.
Subramanyam is the founder and managing partner at Ampersand Capital Investment Advisors LLP. So he brings over 3 decades of experience in the financial markets. And before founding Ampersand, he has gone through pretty much interesting background. So he was a part of institutional equities team at Bank of America Merrill Lynch, where he has been recognized as one of the top rated auto analysts by the institutional investors. Under his leadership, after he formed Ampersand Growth Fund, his fund has delivered 20% CAGR since 2017, and the fund has been consistently been in the top ranks by quartile of NSE AIF benchmarks. So Arun's philosophy is something where he's looking to find right company at the right price and also in the right proportion, which is very important. So his philosophy reflects a balance between data-driven discipline and deep fundamental understanding. So welcome Arun and thank you for agreeing for this webinar.
Yeah. Thanks, Gitansh. The pleasure is all mine.
So thank you. So maybe Arun, if I have missed out something on your professional journey and if you want to highlight a little bit, that would be really helpful.
No, I've actually, no, it's fine. Actually, I mean, obviously, like you said, I started off as an analyst and then finished my journey or a professional journey rather, and then started my entrepreneurship in 2017. And we are here. I mean, I've been managing funds for the last 8 years. We finished 8 years last month, actually.
Okay,
Yeah.
great. So also now coming on to the fund that you manage, primarily our audience
Yeah.
will be HNIs and ultra HNIs. So
Yeah.
maybe you can throw some light about the philosophy that you follow in Ampersand Capital.
Right. So see, it's a single scheme we've been managing right since inception, and when we started it, given me and my team's background of being fundamental research analysts, we thought it would be best to approach each company or any ideation using fundamental tools rather than any kind of other form of investing. I'm not against anything else,
Right.
whether it is momentum or whether it is technical or whatever it is. But we kind of believe that fundamentals is the best way to go about it, which actually you use valuation tools to determine what should be the whether the given company is undervalued or fairly valued or overvalued, and then you go about making that decision whether to invest or not. And that's the philosophy we have actually approached right since inception. The Our whole investment philosophy is based on growth plus quality. Growth is imperative, and it has to be matched with quality. Anything which is dodgy in terms of quality, we are. I'm not saying we will shun it, but we will obviously question it whether we need to have a position on. If so, whether what kind of weights we will have in it. So if you look at our entire journey, 8 years, we have had very few companies where we have actually been totally wrong in terms of uh, uh, going wrong in terms of assessing the management in terms of its quality or the company's track record. So that's something which pride ourselves. Of course, we made mistakes, but that's basically the essence of it.
Got it. And also, is there any other philosophy that you are following since 2017? Because I think 20% is a decent number that you have delivered post fees, post expenses.
Yeah, see, I mean, like I said, it's very easy for me to say yes, great. I mean, we have done 20%, but the fact is that everything doesn't happen because uh, uh, you know I have driven it or my team has driven it. Obviously, the external environment was also conducive for it. There were lots of volatile periods, but 23 and 24, of course, were great years for management investing in general, and for us in particular, because obviously the kind of companies we actually invested in they did extremely well. More importantly, I think what we have tried to achieve in the 20% number, which you see, is that we have tried to be consistent. I mean, there are years where we have actually delivered very muted returns, like in 17, I think 17, 18. But the market itself was negative that year. Our returns are very muted. 22 again, we were quite muted. Again, market was maybe slightly better than us or similar to us. And last 1 year, we've actually not done very well. And again, we obviously have that excuse of saying the market has also gone nowhere. But again, it's been a journey, tough journey, but also satisfying in the sense that we've actually been reasonably consistent, except for the last few months.
Got it. And just one thing that I have in my mind, this is from me as well as a couple of investors, that do you follow some technical analysis or do you
No,
purely fundamental?
yeah, which is why I don't know. I never knew you were going to ask me this question, but I mentioned it upfront that it is completely fundamental. So there's nothing else, no other tools we actually use.
Got it. And also, like, what would be the current allocation of Ampersand? Is it more of large cap, flexi cap kind of a fund?
So, see, we are actually market cap agnostic. We are a flexi cap fund. But having said that, obviously one tends to slot into market cap, into market cap, depending on. See, for example, there are companies which we invested as small or mid caps. Over an 8 year journey, some of them have actually become much larger. So you could say that we are holding a large cap stock or a mid cap stock, but they were much smaller when we invested. So it's not that we actually look for that's not the starting point for us. We don't decide on that. Like I said, growth and quality, wherever there is a match in these two, perfect match in these, and where we think the growth is going to be kind of consistent growth over a longer period, we would tend to look at those companies.
Got it. And maybe if you can give some examples, a couple of, sectors or companies that have worked out pretty well for you, and couple of
Yeah,
companies
yeah.
has not been, worked out very well for you.
Yeah. So the companies which have actually worked out well for us are not working well for us today, as I speak. So I will give you one example of a company which has done extremely badly for us and has been one of the reasons why we have actually, as a fund, not done as well as we should have perhaps done this year. That's Trent. We invested Trent in 2020, 20 and 21. Between November 20 and I think February 21 is where we actually put in a lot of money in Trent. When I say a lot of money, our fund size was very, very small. So we obviously took a reasonable chunk at that point in time. Of course, it was based on the fact that the post COVID, which are the companies which stand to benefit in terms of reopen, and which are the companies which had a strategy of actually adding a lot of stores. It so happened that, and we obviously, like I said, the management capability was never in question. So that is something which we invested in 2021. It actually has been a very consistent performer for us, except in 24 where it gave us oversized returns. We did take some profits in 24, but in hindsight, we wish we would have probably exited that company then, but it didn't happen. But that was one. We still call it as a success story because it's still 5x since the price we invested, despite the fact that last 1 year it has been down 60%. Of course, we don't hold a large position today. We hold a very small position, but it still irks that we hold it still. But like I said, that's one of our success stories. The one story which still we own a big chunk of, and we have held it since 2019, has been Polycab. That's the wire and cables manufacturer. Again, it was more to do with the fact that this company was very well managed. It had a very strong balance sheet. It had this major chain where it actually could. I mean, it's very strict. You go to any most of the wires which are actually used in building constructions or on most of the projects, they are they're made by Polycab, and it had a very strong market presence, and that is the reason why we actually invested in that name, and it was available at throwaway valuations when we actually did invest in it. But the fact is that the company looks a trifle expensive at current valuations, is justified by the fact that the company has been fairly consistent over the last 6 years. It has been giving very, very strong returns, not just in absolute terms, but also relative to the industry it operates in. So those have been couple of names I'm mentioning to you, but these are the ones which, of course, they are large companies. There are other smallish companies where we have actually seen relatively good success. Has been a company called Newland, which is a CDMO player, which we invested when it was a microcap, and we actually exited the name last year when it was still a small company, but it had given an 8x return for us over a 5-year period. So these are the kind of a few names which I'm mentioning to you, but a host of others which have done well for us. Now, obviously, not just this. You asked me about what has gone wrong for us. The one which didn't work well for us was a company called Gland Pharma, which we believed at a given point in time post IPO had a good business model, and was operating at very healthy margins, and we felt that it is a company which had a bright future. But obviously, the execution didn't pan out as well as it should have, and we had to exit at a small loss. And But when I say small loss, I mean more than the small loss. We actually held it for 6 or 7 months, because most companies we actually invest in, we actually we think that we have done reasonably good research on it, and then we invest. But the stock didn't. The execution wasn't up to the mark for the 7 or 8 months we actually held the stock, and we actually got out at a loss. There have been a few others which actually haven't panned out the way we have envisaged, but we try and minimize our losses by either exiting early, or even if we keep it for a fair bit of time, if the company is not been able uh, to deliver the way we had envisaged, we then exit.
Got it. And just one more question that I have. How do you identify the right quality of management when you invest in a company? Because beyond numbers, what makes you,
Yeah,
that this is
yeah.
would be a good business leader and we should invest in this company with this leader?
See, the quality is, I mean, most of the companies which you would deem to be of good quality would certainly have a track record, because so it's very easy to judge which has a company which has delivered consistently. Having said that, for example, we hold a company called, again, the names which I'm actually taking, they're not a recommendation. They're just
Right.
in terms of, yeah. Yeah, see, there's a company we hold now, which I think is become quite a reasonably popular name in terms. A lot of funds are probably holding it. A company called Zomato. Now, obviously, at that point in time when we actually bought into Zomato, it is very difficult uh, to kind of to
Right. That
make an assessment of how good the management quality is. But we felt it was great business. It was a great business, and the team, which the management which had actually thought of this idea of actually the QSR was. I mean, we thought it was a company which actually could potentially deliver if they did the things right. See, quality sometimes you have to have you have to interact with the company, or based on how they actually come across in terms of their idea, and how they actually put across their strategy. That also can some point in time be uh, can give you that view that this management they make sense, and it could be deemed to be good management. But most of the others are mostly typical, that they have, where they have a track record, where they have actually made excellent use of their capital, where they have never had kind of done anything which has shortchanged the minority shareholder and things like that. Yeah.
So, and there are some fund managers which I have heard that they do not invest before they met the management. So, are you one of the fund managers or your primary source is annual report and
No, 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 no. We do meet the management. Now, see, the thing is that I'll tell you, since we actually for every company we invest in or decide to invest in, we do meet the management. But having said that, we did not meet Trent before we invested. trend, I'm just giving an example because that is something which we actually I've said that as a name in your earlier question. But for a company like Trend, you know what the management is, and they don't even meet. Actually, they don't meet regularly. They don't do con calls. They do put out press releases and meet once a year or twice a year in conferences. So that is what we did. But when we invested in Trend, it was COVID time, so we didn't meet them. We met them probably 6 or 8 months after we made that investment. But by and large, our policy is to meet with management, even if it is not the owner, at least the people who are responsible for communicating the management strategy and vision. So we do make it a point to meet.
Okay, got it. And what is the allocation that you make in one company? Is it like your portfolio is diversified or it's a concentrated portfolio? If you can throw some light.
So yeah, see, okay, to understand what I'm going to say, first of all, the difference between, let's say, a PMS or an AIF is that there were some norms which came out in 2022, I think 2021, I think 2021, where SEBI said that we cannot have a concentrated concentration exposure has cannot exceed 10% of the invested amount or the AUM. So 10% is the ceiling for us. So anytime we cross that, we have to exit the stock. So typically, if since we typically invest in growth companies, and if companies grow over a sustained period of time, they can obviously, combined with the re-rating, um, uh, uh, the stocks can give you outsized returns, like in some cases they have for us. So we typically, when we start investing, we don't cross 5%, and I mean maybe probably even less. But then we get more confidence. We go up to 4 to 5%. Um, there have been cases like, for example, Warren Beverages is a case in point where it actually had crossed 10%. We had to exit. Then there was few others which actually had that, we had that problem, so we had to make that we had to take that decision to cut positions. And so we typically, that's the
But
reason why our holdings are never more than 4 or 5% in any stock. And to answer the second part of the question, it also depends on the stock liquidity, and the risks which we are willing to take in terms of the business the company is actually, the business which the company represents. So in some cases, we take smaller positions like 3%. If they are very, very small companies or micro caps or small caps. But 3 to 5% is typically the range of initial period of initial investments where we make, which we make.
okay. And so this restriction is not there in PMSs.
I don't think it is there in PMSs, because I've seen a lot of PMSs having.
Only eight stocks. I have also seen that 8 to 10.
Yeah, yeah. I mean, see, okay. So the part which you answered, do we have concentrated positions or do we have diversified positions? See, our we typically invest in about 30 names,
Okay.
at most. So if you divide 100 by 30, 3 to 3.3% is the number which comes. So which is why I said, so somewhere between 2.5 to 3% will be small caps, mid caps will be 4%, large caps will be 5%. And again, I said, when I say large caps, we don't invest typically too much in nifty names. They are typically junior nifty or mid caps, which potentially can become large caps in those kind of companies.
Okay.
So yeah,
And just one more thing, that a lot of investors also ask that yours is category 3 long only AIF. So there is also one thing that you can take advantage of, that you can also do QIB or anchor
yeah.
booking pre-IPO, that you do that, or are you willing to do that, or you will stay away from?
No, no, no. We do that. We've done it quite regularly. But the only thing is that it's very difficult to get allocation in all of them. You get allocation mostly in the ones which actually uh, don't get immense response. So ours being yes, we are an AIF, but we are not a very large AIF. We are a boutique firm, and we are just 1,000 crore AUM. So it's very difficult to attract, not attract, for to get allocation of every QIP you want to show interest in. So we have managed to achieve get some reasonable success in the QIPs we have invested in, but it's not been a very large number.
Okay. And primarily your AIF avoids micro caps, right? You don't
We
kind
don't avoid it as an avoid, but like I said, when I said Newland was a micro cap when we invested in it, which is probably 10, 1200 crore market cap company. So that's probably would qualify as a micro cap, unless you say it's 500 or 600. Yes, 500, 600 crore companies we don't typically invest in, but 1000 crores is kind of micro cap. But if you look at our portfolio, whether you see it in 2017 when we started or right through now, or that companies with market cap of less than 5,000 crore would never be a very large proportion of our portfolio. At best, they will go to 10 or 12%, or maybe currently it's about 5%. That's so it's not that it's a strict no, but it will be a very small proportion of our
overall
uh,
allocation.
yeah.
Got it. And your portfolio shows a strong visibility of earnings and profit growth for financial year 26 around 24%. So
Yeah.
how confident you are about sustaining that growth in a environment where there is too much volatility over a broader market?
Yeah, actually, that's a good question because when we did this, see something which I should have told you right from the beginning. The growth plus quality when I had defined this whole growth. Now, the growth is a number, right? I mean, there's certain companies which you think can deliver 25% growth. There's certain companies which can deliver stronger growth, faster growth. But the more important thing is how sustainable will that growth be. So we typically go for sustainable growth, and for sustainable growth, typically 20-25% is a number where you should be very happy with, because I don't think you'll get too many companies which can deliver anything more than that. So in our portfolio, when we make an assessment and we make an investment into such companies, we typically look for 20 to 25% as the base number to for companies to invest in. And it so happens, as you mentioned, that number, the visibility which you have seen for this year, strangely has still happened for us this year. But our fund has not done well because some of the stocks already had done well last year and the year before, and those stocks have got derated, right? So in terms of growth, yes, we are reasonably confident in terms of the companies, kind of companies we invest in, that overall as a package you will get that kind of growth. For example, we hold ICICI is not going to deliver 25% growth. They'll probably just deliver 10 or 12% growth. But you add that to a Zomato or some of the other names you hold, you get a combined blended growth number of that 20 or 25% which you're talking about. It's another other matter altogether whether a portfolio can also deliver that kind of return or not.
Okay. So also, do you have any in-house screener that you run, for example, 15% ROC, 15% ROE, something like that? Any criteria that you follow?
Yeah, see, some of it is actually of the years of experience. We have actually looked at many of these names, but yes, we do run a screener of certain basic parameters. Yes, a company where revenue growth has to be at least in double digits, at least. It could be 12 to 14% or somewhere thereabouts, at least. A company where margin expansion is a priority for us. So now if your screener or any kind of data which you look at may or may not reveal whether the company's margins are in a upward trajectory, or they may. But for for us, it's very important that a company, if a company is delivering, let's say, in this environment, as you can see, it's very difficult for companies to achieve very strong revenue. But there's you can make a case of companies expanding margins, then that will add to that revenue and give you the multiplier to generate that 20% plus profits. So the screener which you're talking about, yes, we do look at a minimum criteria of revenue being reasonable, and a company where margin expansion, which either the company has delivered in the past, or where the company is in a business where where competitive threat is not as high as which would worry us in terms of where the margins could go. And of course, like I said, when you look at most quality companies, they are low on debt. So that's leverage is something which is very important for us. Other than the one or two banks we hold, we don't hold any leveraged companies. So that also will show up in any screener uh, which we try to look at.
I think you have highlighted most of the important points, double-digit revenue growth and no debt company. I think these are very much important criteria. So now, generally, we say that the best lesson that we can learn is from history. So maybe you started in 2017. If you can define a period of 2017 till 2020, I think from 2018 till 2020, small and mid caps were kind of not doing well, or there was some problem. So maybe if you can define that for our audience, what was exactly happening, which was the market cycle we were in at that point in time?
Yeah. So, not many people remember pre-COVID days. I mean, everybody measures their performance from COVID. So, I mean, performance for we also have a very good number if you start us from COVID. We, but I always try to highlight that we were there before COVID and we were there after COVID. So the best way to probably look at us is to look at since inception. So to 17 was a very difficult year. 17, 18 were very difficult years. 19, 20 was still okay. But 17 was a market peak at that point in time. I think the peak happened in August, if I'm not mistaken. We started in September, um, and then the market did not go up at all in 18. In 18, it did not go up at all. SEBI changed, had some market classification norms, market cap classification norms, but as a result of which a lot of the mid and small caps were reclassified, and you saw a lot of funds exiting those such names or rebalancing those names. Calendar 18 was a very bad year, and it ended with the major credit crisis which happened towards the end of in the last quarter of 2018, when companies like I think DHFL and Yes Bank, I don't remember all the names, but they actually went down under. So it was the year was washed out for the market as a whole. We delivered 6% return, which we thought was very poor, but then we look back, we thought it was great because we somehow managed to save ourselves. 19 was an okay year. I think we gave double-digit returns. The market also gave that kind of return. 20 onwards, everybody knows what happened. So there's nothing much to highlight. You Certain funds in the fateful month of March fell a lot, and then they went up a lot in the next 6 months or 1 year. So we also fell, but we didn't maybe fall as much, but we did fall quite a lot, and then we went up. So that's okay. I mean, that's not.
That's part of the journey, I believe.
Yeah, yeah,
You have to ride all the cycles. So
yeah,
now moving on to the last part of the webinar, where we'll be doing just some general discussions about some sectors or some industries. So maybe any sectors or any themes that you feel would, obviously it's very difficult to predict, but
yeah.
you have something
Yeah.
next 3 5 years.
So the narratives and themes which we have been typically over the 8 year cycle we've been focusing on, or not focusing on in the sense these are the ones we typically want to invest in because we think that we have reasonable expertise or we have the means to track it well enough. One has been consumption. The other have has been since 22 we've been actually looked at is the investment grade sector like power. Power, railways, defense, some of those companies which we started looking at only from mid 22. Then we like looking at companies with new age technologies. I don't mean just IT, but anything which has to do with the new age technologies, whether in terms of platform apps or whether in terms of companies doing R&D. It could be manufacturing like pharma, or capital goods or engineering, and it could also be in some cases product companies in IT. It could also be that. So these are the three. And of course, there's a financial space where we typically don't invest in lenders, but mostly the non-lenders like wealth management companies and exchanges and things like that. So these are the four sectors, if you may call it, not sector actually, but kind of spaces we have liked to invest in over the last 8 years. So when you look at where we stand today, this year has been very, very volatile. I mean, for all the reasons everybody is aware of. Um, uh, our shift in focus has been more towards consumption and domestic driven names. So uh, uh, that's something which we think should do well. Now, obviously, some of it has already played out in the last couple of months with the GST cut and all that. Uh, uh, and we are probably entering this festive season of the peak of the festive season. It all remains to be seen what happens after that. So that's one, but it's a sector which we think should do well for India, because obviously we are in some sense insulated from the global what's happening globally. Plus, the RBI has been reasonably supportive in terms of easing the credit crunch. So we think that credit growth should pick up after 12 months of squeeze on credit on credit. So by and large, I think consumption is a space which should do well in the next 12 to 18 months. The new age space, which I was talking about, that is something which we'll continue to explore. But there's difficulty there is it's very difficult to gauge the kind of expectation which you can make in a particular company, and valuations are kind of insane. So that's something which, but we think wherever Indian companies have a advantage or edge, and they are in the right spaces, whether it is the hospitality, travel related, those kind of companies, those will do well. So so these are the two we are actually focusing on. And of course, defense as a overall theme should do well, but it's going to be lumpy. It's not going to be even. You're not going to see numbers coming in immediately, and it'll happen over a period of time. So you'll have to be careful there. But it's another space which we think should do well for Indian companies.
All right. I think that's a good answer. And also, we are seeing a lot of EV cars coming
Ah,
in.
yeah, yeah, yeah. Sorry. I mean, I should have mentioned that. So you're right. So anyway, finish your question. Yeah.
No, I was just asking your view on auto sector and chemical
Yeah,
sector.
yeah. Yeah, yeah. So EVs is something which we are also kind of looking at very favorably, except that, again, it's one of those things you have to make an assessment about which companies. See, like it happened in autos, if you go back for 30 or 40 years ago, uh, uh, there were many companies which actually came in the 80s. I mean, once the government had freed up the auto sector in the mid 80s, or when the Japanese companies came in, the Korean companies came in, and all the companies came in, and there was the auto boom and there was the ancillary boom that happened. But ultimately, only two or three companies, maybe two companies in every segment, could stand out and do well. The rest of them actually faded away. And the same thing is going to happen in EVs. So one, in EVs, where is the adoption which is going to which segment is going to see the highest adoption? That is the moot point. That, of course, but now is proven that the two-wheeler space is going to see the highest adoption. But within that, there probably are close to about 8 or 10 players. Not all of them will take the lead. There will be just one or two you have to focus on. So yes, we are interested in those companies.
And do you see, because you have also, I think, some pharma companies in the portfolio. So
Yeah,
do you see the impact of tariffs, which is important from US, or is it all,
yeah. So last month, the U.S. administration, of course, imposed tariffs on pharma on drugs exported to the US, but they spared the generic space. The generic was spared, and that's the reason why. But of course, there's collateral damage, and the pharma sector, there was negative sentiment, and pharma sector did badly. But overall, I think we are very in pharma. A, because of our cost competency, and B, because of the fact that we have very skilled professionals who are able to replicate these processes and uh, uh, make low cost drugs. And there's this huge market which we understand. And so we think pharma is a space which, although there's a strong narrative for the sector itself, but it's mostly going to be bottom up. There will be companies which will actually do a lot better in terms of exploring that opportunity. So we like pharma as a space, and especially in certain pockets like CDMO, and now the latest has come about in the GLP-1, which is a lot the weight loss drug, which is becoming very popular, and that will actually see a lot of patents going off patent towards the end of the decade. So that's a space which we actually like.
Okay, great. And because you have, quite experience around 3 decades and you have seen a couple of cycles. So do you have any view on the commodities like gold and silvers? Because
Um,
touching volatile.
so yeah, so we don't invest in commodities. When I say commodities, I mean every commodity, whether it is steel, aluminium, copper, chemicals. We don't, simply because we don't understand the cycle very well. So for me to therefore definitively say what will happen to gold and silver is obviously foolhardy. But it's become a very common. I mean, it's a common view that everybody's consensus view that everybody is saying that gold and silver are the go-to precious metals to invest in, and they've been proven right so far. The question now is that to get into gold and silver at these levels when they've already delivered such superlative growth, not just this year but over the last 5 years, especially since gold, I think, bottomed in 22 or 23, and then of course has given this phenomenal return. Silver, of course, is trying to catch up and do even better now. But it's very difficult to therefore envisage us taking a positive view on gold for the short term. But yes, I think as a trend, one could probably say that it's in positive territory and should do well.
Okay. So just the last couple of 2, 3 questions and then we will wind up. So
Yeah.
we have a couple of clients who are high net worth individuals and some are NRIs. So many of whom are exploring AIFs also, PMSs also. So how would you just simplify the difference between the PMS and your Cat 3 AIF? If you have any in mind?
So the very very simple way to look at it is this: AIF is similar to the mutual fund, except that mutual fund is pre-tax and we are post-tax. In the sense that as long as you've invested in the mutual fund, your returns, what you see, your NAV in which you get your allotment, and when you exit will be pre-tax. So when you get the money, when you get your redemption proceeds, you have to pay as an investor. You have to pay tax on your proceeds. In AIF, right from inception till the time you get your money back in your pocket, everything is post-tax. Now, in so that's this difference between mutual fund and AIF. So everything is post-tax. There's nothing to be done. Difference between PMS and AIF is that PMS again is completely pre-tax, but here at every stage, whether it is every quarter, the investor will have to consider the tax liability and make the payment to the of income tax. So it's a quarterly pain which you have to go through. But the advantage, of course, is that you have your portfolio in your own demat account. You can see your portfolio, what the investment manager is doing and what he's so you have informed decision on what's happening on a day-to-day basis on your portfolio. It's not that AIFs don't reveal the portfolio. We reveal it every month, but obviously that is some advantage which the PMS schemes have, which the AIF investors don't.
Okay. And just the one personal question that what keeps you going? Like, what do you personally enjoy most? Is it something managing, people's money, or is it finding the next multi-bagger, or is it something, client relationships that you enjoy in your professional life?
So, it's easy to say all of it because I have been doing since I started my career in broking in investing in the early 90s. And so it was a passion. I wanted to get into understanding companies, how to invest, and how to make other people invest. So that's been all life. And I've been marketing my own research right from my entire professional career. So this is just an extension of it, except that here I'm managing not just my own money, but people who are giving me, we have enough trust in me to have reposed their trust for me to deliver. superior returns and some alpha. Uh, so uh, so there are so that obviously gives you a high that if you deliver that, there is also a bit of pain if things don't work out, not just for the investor but also for the fund manager, investment manager, and we realize it very fast. I mean, we know that if things are not going right, like they haven't gone right in the last few months, then you know that you need to probably either change your strategy or take a relook at how the company, your portfolio, which we do. But this year has been more tough, and it's taught us a lot of lessons as to how to be more nimble and to in the profession. So yeah, but I still enjoy it. I still enjoy doing what I'm doing, the ups and downs notwithstanding. So this is something which will keep me going, hopefully.
Great, great, Arun. And just last thing that, there is a saying that time in the market is more important than timing the market, right? So a lot of investors also keep on waiting. They fall like COVID will occur again. So any message to those investors, or should they invest their money? Obviously, everyone has to look at their own capital, own allocation of funds, debt, and equity part. But still, you think that we should wait and time the market, or should we invest in tranches or whatever we have? Any views?
So timing is important, but if you're managing your own money uh, with no responsibility towards others, uh, then it's you have to you the thing one has to remember is not to get swayed away by momentum or what's being told to you. uh, Anything you invest in, see, time it gets evened out if you've done enough work on the company to understand where you're putting your money. If you know where you're putting your money and what it stands for, irrespective of whether it's a commodity based company or a branded company or whichever space it is, as long as you are on top of it in terms of understanding what the company does, you should not worry about time. The timing gets is now getting a little important now in these times, is because every Friday you know that there's going to be some bombshell happening somewhere, not literally but at least figuratively, some announcement that it keeps coming. So therefore, when markets are not able to hold up gains for a very long time. So you know that if markets go up a few percentage points, you will get an opportunity to get in at a lower price. So one should not be chasing momentum. So this is not a moment. This market is not for momentum unless you're completely nimble. If you're fast in buying and selling, that's a completely different matter altogether. Which we are not. We are a long only fund. We are not capable of doing that. But playing momentum is not advisable at all, at least more so in this market.
Got it. I think you have answered all the questions pretty well, Arun, and you have articulated the entire webinar very well. Most of the investors who are watching us would, I think that they will be having a keen understanding that how you manage funds, at least your Ampersand Capital, how it operates, and what is the allocation and everything that you have answered. So thank you first of all for agreeing for this webinar, and just look forward for more conversations.
Yeah, thanks a lot, Gitansh, and yeah, hope we continue to stay in touch, and let's see how things go.
Sure,
Thank you.
sure, Arun. Thank you.
Thank
Thanks.
you.